around the next candlestick open. Okay, you make entry on the next candle open after confirming that bullish movement from the second candle. This will be the, then you have that which is trying to establish a trend. This one confirms it, and then you can now make entry on the next. And then possibly you look for the nearest support zone. You measure that distance, you establish your margin call drop for your first call. You get that? And same applies when a spinning bottom. You have to wait for a clear. If it is formed in the course of a downtrend, and the intention, and then maybe trader's intention is to now push the price to the upside. If it is formed down there, this is what should happen. You have that. Then you're going to have maybe this assume that was the downtrend. Then you have a bullish candlestick there. You have to wait for the next to form, and this would clearly indicate that the trend has reversed after the indecision. Then you can make entry on the next candle open. But then even before you do this, you decide on making this entry, you need to have confirmed at what zone the spinning top has been formed. Is it around the support zone? And above all, then you may have to add in maybe an indicator, for example, like an indicator that helps you state the status of the market, or understand the status of the market. At that point, as the indecision candlestick is being formed, and you see that it is being formed around your support zone, what is that, for example, the stochastic RSI trying to indicate? Is it indicating that that candlestick, that coin has been oversold, or has it been overbought? Because that will step in, will add some flavor in your decisions of entry. If you realize that the spinning top has been formed and yet you're trying to see some sort of a bullish movement, and yet it is being formed around the supply zone, then that will be another trap. So you relax. So spinning top on indecision candlesticks are not the best for making entry. But if you must, then you need to make a lot of confirmation for you to make entries. All right. So I hope that is very clear. Now, when you go to the next category of the candlesticks, we are going to the inverted hammer. Now, the inverted hammer is a bullish candlestick as well. Now, normally, how they are formed, they are normally formed when they are formed in the course of a downtrend. Just a minute. Okay, let me clear my chart. Now, an inverted hammer, most of the times it is commonly formed around also a support zone. So when it is formed around the support zone, in the course of a downtrend, it will be indicating a bullish movement. But remember, if it is formed in the course of a downtrend, right? This was the market price moving in the course of a downtrend. If it is formed, if you sight at it around there in the course of a downtrend, either that having a lower wick or that one without a lower wick, what you should know that when you see it having the long upper wick, remember, any candlestick that has a long upper wick is a sign of a selling pressure, right? Is a sign of a selling pressure. However, if an inverted hammer is formed around a support zone in the course of a downtrend, it indicates automatically a bullish reversal. Meaning this range here is going to be filled up by the next candlestick, by the next bullish candlestick. This selling pressure simply would be the effect. Remember, when the price is in the course of a downtrend, what brings about a downtrend market structure? It's either continuous selling or massive sell, which may result from either panic or may be resulting from traders wanting to simply take profit. You get that? Or short the market. So what happens when the trend is on the course of a downtrend, or downward movement, and then you sight at hammer, for example, formed around the support zone, and then you see this. First of all, don't be scared. Don't try to be scared, especially if it is a bullish candlestick. Remember, an inverted hammer It is a bullish candlestick. So if it is formed around the support zone, just be rest assured that the price may fluctuate around there, but just know that the intention of traders around there would be to move the market price to the upside. It won't so much be an intention to continue pushing the price down, provided it is at a support zone. And when you have your supporting tool, like an indicator trying to help you understand or know the status of the market being around the demand zone, it will be a clear bullish reversal. Because if you see here, I'm saying that it indicates a bullish reversal. Now, depending on where it is formed, okay, like if it is formed around the support zone, the best you're going to do is, if it is formed, make entry on the next candle, open. Once you see an inverted hammer, you make entry on the next candle, open. And then you take profit to the nearest resistance and measure that to the nearest support, and the percentage you get there will be for your margin call drop number one. Now, I'm going through this literally because I trust that it's not the first time you're handling this, but I'm trying to help recap and probably make some of the people who probably is their first time to attend this to just have an understanding of the candlestick. I trust severally, some of the leaders have handled this, and their approaches could have been, you would have understood their approach. So this is just to add in more flavor on that, on what you already know. Now, when we're through with the single candlestick pattern that we commonly know, we are going to look at the double candlestick pattern. Now, when you talk about the double candlestick pattern, we're referring to those candlestick patterns. Those candlestick patterns that appear in pair, okay, whose significance is that they have effect on the price whenever they are formed on the chart. And the effect may be either an intention to push the price up or push it down, right? And the one on the agenda, or the first one on the agenda, is what we call the bullish engulfing. The bullish engulfing candlestick pattern is a common one that most people know. It is a bullish reversal candlestick. It is formed mostly at the end of a downtrend. That's where it is formed. And it is made up of two candlesticks. And this candlestick it begins with a bearish candlestick, which is a red candlestick. And then it follows by a bullish candlestick, which is normally green. Okay? That's what constitutes a bullish engulfing. Now, in these two pairs in the pairs of the candlestick that is going to be formed, which we're calling the bullish engulfing, most of the times the green candle or the bullish candle should be bigger than the red candle, to an extent where if you try to fit in the red candle into the green candle, it will just fit in automatically, meaning the green one will cover it up. It will swallow it up, right? It will engulf it. That's why it is called a bullish engulfing candlestick. The green one engulfs the red one. Now, most of the times when it appears in different shapes, okay? It can appear in different forms. One, you may find it in this way. The first scenario may be you'll have a red candlestick there, and then you have another candlestick like that. Okay, so this being the green one, and this being the red one. That is the first instances on how you can find it. Another scenario, you may find it when they are actually having they are appearing like this, for example, like this. Then you have something like that also. Okay, that is still equally a bullish engulfing. Like where the red candle closes is where the green candle opens from. In some other instance, you may have that, you may find a green candle opening slightly below the closing price, just because of the fluctuation. Yeah, it may not be opening at the same price. It may open slightly below. But at the end of it, if you look at the size of the red compared to the size of the green, if you try to fit in the red into the green, it will fit in automatically and perfectly. Same applies to this. If you try to push it so that it fits there, it will fit in automatically and very well. Now, when you sight at a bullish candlestick pattern in the course of any downtrend, it is a bullish reversal signal, meaning that the best entry you can make in such a scenario is we wait for this formation to be confirmed, then you enter in the next candle open. Immediately, you enter in the next candle open. So when you make entry on the next candle open, then you will take profit to the nearest resistance. And then from that point of entry, just slightly measure your range to the low of the two candlesticks. So you look at among the two candlesticks, which one has the lowest low, right? Like in this case, the red one has the lowest low. So that becomes your perfect support zone in that regard. And then your entry zone will be around there. So you look out for the most recent swing high, where you're going to establish your resistance, and that will be your exit point. For that one person who intends to buy or take a long position, then this one here will become your margin call drop for the first call. Now, the beautiful thing about the bullish engulfing candlestick pattern is that it is a powerful bullish reversal pattern that normally tends to pick up immediately. Okay, unless you're aiming at a very big take profit. But most of the times, when you just make entry on the next candlestick and then you take profit to the nearest at the nearest resistance, not looking at the bigger one, at the nearest resistance, it will always deliver instantly. But if you want maybe a bigger TP, that's when it may go at some point. Once it encounters a resistance, it may come down. That's when it will, it will hit your margin call drop, which you have established. Okay, there will be an order. There will be a call made after it dropping to where you had established your margin call drop. Then at a later time, it will pick up and deliver that high profit that you had set. But it is, as long as you're going for a 1, a 1.5, a 2%, most of the cases it delivers. Okay, it delivers. It does deliver. Okay, so that is an example of a double candlestick pattern. The next example is the bearish engulfing. Now, the bearish engulfing is simply the opposite of the bullish engulfing. It operates in a similar manner. Now, for it is formed towards or at the end of an uptrend. Now, when it is formed, once it is formed, what happens there is if you want to make any entry in that regard, and this is for possibly those who are taking short position, once you're inside at a bullish engulfing candlestick, make entry on the next candlestick open, and then locate the most recent or the nearest support zone that you can possibly find. From that point of entry, just measure that difference. The percentage you'll get there becomes your margin call drop. Becomes your TP. Even if you get 1% only, or 2 or 1.5, just do know that it's gonna drop to that support, because this is already a serious bearish reversal pattern. It may hit or it may not hit instantly, but definitely it will do. All right. Then only from point of entry, just for in case scenario, okay, in case it tries to move a little bit up, you can also measure that percentage to establish some margin call drop to take advantage of any eventuality of the price going against you. Because in so doing, it will be helping you, one, try to have an effect on your average price. So literally, if it can try to move up a little bit, what it is going to do is, if the bot buys around there, you may even exit the market earlier before when the price hits this other support zone, because the effect on the average price is going to move the average, is going to create a small gap between the average price and the price at which you made entry. And that would mean an advantage to you of exiting earlier. Because if, for example, that distance here was like 1%, for you probably you may be exiting out of the market when the market just goes by 0.8 or maybe 0.7, just because of the effect of allowing the bot to buy once it tried to move against you. So the margin call becomes a key part of your trading if you want to benefit from such scenario. So that is how you make entry when you sight at a bearish engulfing candlestick. So I hope we are still moving on well. I hope we're okay up to that point. I hope we are good up to that point. Are we still okay? No. Okay. All right. Okay, so let's look at the next. There's what we call the tweezer bottom candlestick pattern. The tweezer bottom and the tweezer top. I'm going to look at them at the same time. Now, let me come here. What is my... Okay. So let's talk about the tweezer bottom and the tweezer top candlestick pattern. Now the tweezer top versus tweezer bottom. Okay. I'm beginning to tweezer top and tweezer top, tweezer bottom. Now the tweezer bottom. Bottom. When I talk about bottom, you should understand bottom. The tweezer bottom is a two candlestick price action pattern whereby you have two candlesticks that are having equal lows. Equal lows. Meaning you have two consecutive candles, or you have, each has equal lows. The lowest price registered, like the lowest price registered for the next candlestick is going to be the same as the lowest price registered for the previous candlestick. So for example, you have something like this. Like this, it always consists of two candlesticks. Number one, there is it may appear like this. You may have something like that. And then you have another candlestick, and which may be like this. Okay. But when you try to look at their lows, if you try to draw a line connecting their lows, okay? Yeah. Okay. A minute. So if you try to connect their lows, try to draw a line that should connect their lows, you realize that they have equal low. So it consists of a red candlestick, and a green candlestick following each other in that order. Okay. It is normally formed in the course of a downtrend or after a downtrend. So as the price is moving downwards, and the moment you sight at a tweezer bottom, what you should know about that trend is that you'll be having a very strong support zone around that area. Once a tweezer bottom is formed, know that that area where the tweezer bottom candlestick pattern has been formed is a very powerful and a strong support zone. And what does that have to tell you as a trader? That especially because it is formed in the course of a downtrend and you're starting at a tweezer bottom, it is a strong bullish reversal pattern. It means within that zone, no matter what, the price is going to be supported, and the only option that will come in play will be the price to reverse and begin moving upward. Because not only that it has to do that, because it will be presenting a buy opportunity. It will be a point where most traders will be eyeing at to make entry in the market. Now, because of the strong support, it qualifies, or it is regarded as a strong bullish candlestick pattern that is formed. So it may be formed like that. It may be formed when it is, you may have two candlesticks like that, okay? Two candlestick pattern like that. They may even not have the lower wick, okay? But for as long as where this one closes from is where the next one opens from, and it is the same price, even if there's no wick on on any of them from the bottom side, it will still qualify to be a tweezer bottom, because what qualifies in a candlestick pattern to be called a tweezer bottom is that the two candlesticks that are following one another, okay, should be having an equal low, meaning all of them should register the same price for their low, okay? That is a tweezer bottom. Now, when you sight at a tweezer bottom, ladies and gentlemen, because it is a strong and a powerful bullish reversal pattern, immediately you confirm that it is truly a tweezer bottom, go and make entry. Just wait for the second candle forming the tweezer bottom closes, and then you make entry on the next candle open. Okay, make entry on the next candle open. Then try to measure that distance from the point of entry to the lows of these two candlesticks that are forming the tweezer bottom. That distance, that range, is what you go and establish on your bot as your margin call drop for the first call. Now, in that case, you're trying to prepare for a scenario of the in case the price tries to again dip a little, okay, to come and touch on that very same support. That will be like the third support being retested, right? Being tested. So if it does that, you're preparing for such scenarios such that you can take advantage still, because you know the effect of what that would mean to you when the bot buys again. You'll be buying it cheaply, and above all, you'll be having that opportunity of your average price being moved closer to where you made entry. So that will also imply earlier exit, okay? And depending on the strategy you'll be using, okay, the strategy you're going to apply for the multiple buying ratio section, depending on what you're going to do, especially if you understand the concept of the martingale, okay, or you go for a strategy that allows for doubling or tripling or even quadrupling your position whenever the bot buys. That means you have a powerful advantage of you leaving the market as quick as possible, all right, and avoiding those scenarios of delayed trade delivery, okay? So that is another thing for another topic for another day, especially on the strategy there. But it is very important that once you sight at it, that's how you go about it. So it is formed in the course of a downtrend. Now, the next one, which is the tweezer top. The tweezer top is a tweezer top is formed in the course of an uptrend. The price is on a rise, and then you have two candlesticks. One being a green candlestick or a bullish candlestick. Okay, that is like that. And then the other being a red candlestick, like that, with a high there. But if you try to draw a line connecting the two highs or the highs of the two candlesticks like that, you realize that the high of this candlestick is equal to the high of that one, right? All of them are at the same level. In that case, this candlestick pattern will be regarded as a tweezer top. Tweezer top. Now, it means why the two candlesticks will have equal highs. This equal high will represent a strong resistance around that zone. That no matter what, once the price tries to push around or above that area, it is going to be rejected. There is a powerful force that is going to be rejecting the price from going where? Down. So it won't help it other than trying to, first of all, pull back, maybe gather momentum, and it can break at a later time. But already, this is a powerful bearish reversal signal. You get that? It is a powerful bearish reversal signal. So once you sight at it and you want to make entry, when you confirm any any tweezer top scenario, just wait for the next trading session to start. Make your entry there. Take your profit to the nearest support. Okay. And then measure that from point of entry to the top of the two candlestick. The percentage you get there is the margin call drop for the first call. Now, ladies and gentlemen, I must tell you this. What I'm sharing with you is practical and applicable. You don't have to so much overthink or overimagine things. I want you to take a moment, go and try it out. Go and try it out when such candlestick patterns are formed on the chart. And you follow up just the way I have explained it, and you try to make entry. And see what the result will be like. There is a powerful candlestick pattern. That's the groups of traders who just based on the candlestick pattern to trade. We talk about indicators, they don't even think about it. For them, they're based on real price action. They look at how the development is happening in real time. And depending on the trader's behavior, which is translated onto the kind of candlestick patterns being formed, they are able to make to sight at perfect entry opportunities, make entries, and they actually get the profits they want from the market, just from the candlesticks. As long as they have those knowledge of support and resistance, because for you knowing that a tweezer top is a very powerful bullish reversal, bearish reversal signal, you need to first of all understand what would have led to what is trying to happen around that zone. Why has it been formed around that zone? What is literally hidden around that zone? Okay, is it a powerful force, which in this case will be a resistance? And once that happens, and you know that that's how it is, you know you will make always perfect entry decisions. Okay, so just try to go and try to try to apply this. Okay. So I hope that is very clear about the tweezer top and the tweezer bottom. So I would want us to just probably just go to this is the triple that will be the day. So let's come and try to see. Let's just try to look at a few of them. Let's try to see if we can find a few of them. I hope that has been clear for everyone. or we can go to the chart, try to identify a couple of them, and then you see how they're possibly fared out when they were formed. Is that okay? Is it okay for everyone? Okay, so excuse me. So let's just go to the chart. Go to the chart and try to look at a few of those examples of the candlesticks we've talked about. See what happens when they are formed, what happens normally. When we cited them, what happens? So it is what we're going to do. Next. So let me, oh, I'm not sharing. Let me share the screen. Share my screen here. Right. Okay. So, so let's try to see if we can get a few of those. Let me see on this kind of thing. Let's see on this coin and we'll see if we can find some info. All right. So we looked at we looked at a bullish engulfing, we looked at a bearish engulfing. So let's begin with this. Let's begin from here. Okay. Now, what we're citing here, what could this be? What's happening here? Let's begin from this point. What have you guys seen there? Let me see on the chart. What is that pattern formed? What is that pattern? What is that candlestick pattern I've just marked? This pattern I've just marked. This one here. Let's have a look. What candlestick pattern is that? Around there. We have this movement. Then immediately we had that red candlestick. What pattern is that? Let me see on the chart. Bearish engulfing. Bearish engulfing. Bullish. Whoop, really? Bullish? Bullish harami? Oh man. Did we talk about bullish harami? it's a bearish engulfing, right? I think a number of you got it right. Now, if we cited a bearish harami, what did we say about entry? What did we say about entry? We have already cited this as being a bearish engulfing candlestick, which we said is a candlestick pattern formed in the course of an uptrend. And if you try to track through, indeed, this was an uptrend. If you track through this movement, this was really an uptrend, right? Because we registered a break of structure around this area, okay? After it being rejected for the first time, the next time we had that break of structure, which was very evident. Now, to form the new so if you have that resistance around there, so we have that. Let me just try to draw it there. Oh, man, sorry. write together. That will be our resistance, right? That point, right? That is our resistance. What is that? Let me see. Let me see. So that's our resistance. Okay. That will qualify to be our resistance, isn't it? Yeah. So we have that being our resistance in the course of that movement. So we mark it there. And we have seen a bearish engulfing candlestick. All right. That means, what will we do about entry? What did we say about entry? How do we make entry when you see a bearish engulfing candlestick? Exactly. After the bearish candlestick close is where we make entry, right? Then we take profit. In this case, what are we doing? Are we shorting or we're longing the market? We said we make entry at the next candle open, meaning we are going to wait for that bearish candlestick, which has engulfed the green one, to complete, and then we enter in the next candlestick pattern. So in case we do that entry, what are we doing? Are we shorting or we are longing the market? We are shorting the market, absolutely. So when we are shorting the market, where should our eyes be at as our exit point? As per our exit point, based on what we said. Where will be our exit point? Where are we going to exit from? You can have a look again. We already make entry. We're already going to make entry around this part, right? This candlestick open is where we're going to make entry here. So where do we exit? Where are we going to take profit to? Remember, we are shorting. To the nearest support, absolutely. So to the nearest support that will come across as the price continues down. So according to our nearest support, when we tracked it, when we track that upward movement, we realize that this is our nearest support, right? This was the line that was broken earlier on. Okay. After this break of structure, after it being resisted here, okay, we had a break of structure around there through that candlestick, that green candlestick. And we say this is a true breakout because we said a true breakout happens when a green candlestick opens from below and closes above. Then the next one opens from above and closes above. That will be a confirmation candlestick pattern. I mean, a candlestick in a breakout above a resistance. So meaning with this breakout, this area qualifies to be our support, the most immediate. So we're going to measure from point of entry. If we just make entry there, we're going to take profit to this support. Okay, this is our nearest support. And then what do we say of the call drop? Our first margin call drop, where do we establish it? Where do we establish it? Where do we establish it? Have a look. So from point of entry, our first margin call drop will be a measurement up to where? To the nearest resistance. Let me save you that. So we shall make measurement from that point all the way. From point of entry, immediately we make entry, we are going to measure to our resistance. That will be our margin call drop. All right, that will be our margin call drop. Now, when you have there's something I didn't tell you. When you have a bullish reversal, a bullish engulfing or a bearish engulfing, remember it will be a big candlestick, right? Now, the best you can do is when you want to maximize and get the best out of that movement in terms of, the robot buying to bridge the gap between your average price and, between the market price and the new average price. The best thing is you measure the mean average of that candlestick, meaning you measure half of that candlestick. You measure the candlestick and then you from point of entry, like for example, you will see, you will measure halfway. From here, you know that the entire distance is 3%. Now you measure halfway from point of entry, halfway that candlestick. This is the red candlestick, right? You measure halfway. maybe around there or here. And that one there, because you want to take advantage, okay? You know it is going to go at a later time. It will go at a later time to really test your resistance, right? Where it will buy that order from. But you also want to, first of all, take advantage of this immediate movement. That may happen after a small retracement and then finally delivering. So meaning you have to measure midway, that candlestick. So if the distance between point of entry to your resistance is like 3%, that means half of that is 1.5. So you'll measure that distance. The percentage of the half is what you're going to establish as your margin call drop for the first call. Then the other balance will be for your second call. Now, this is for a later delivery. But remember, for a smart trader, what you would do, sometimes people take partial profits, all right? If their interest is to take maybe a bigger TP, they will also cater for such scenarios of a later revisit so that we can have a next movement that will give us a bigger TP. You get that? So they will first of all measure that, they take partial profit, and they retain some position in the market for that later delivery, for the bigger TP. But as for us, we can go for we can go for what we know, what we are used to. Closing your trade. It sells everything, it clears everything at once. Then you wait for the next. So it's just that. So if you want to do that, that's how you would go about it, especially only for the bullish and bearish engulfing. You would measure half of that engulfing candlestick. And then right from point of entry. Then the percentage you get is what you're going to establish for your margin call drop for the first call. And then the other balance will be maybe for the second call. But just like we say, for these patterns, normally, this reversal, this strong reversal pattern candlesticks, what happens is that they always have a faster delivery, okay? They always deliver quickly to the intended direction that you are, that it is signaled to move to. So here, that is how we would go about it. So in this case, we would have our price, our setup like that. And then without wasting time, you realize that when we made entry, the price just moved a little bit and later on delivered to our TP, right? As simple as that. There was multiple, there was some double top here. I think this midway was also some serious support zone, but invisible. Okay, but that is how you go about that. So that is an example of a bearish engulfing. Do we look at one example of a bearish engulfing, then we go for the other? Oh, that is enough. We go to the next. Do we look at the next? Oh, that is enough. Do we look at one more example? For a bearish engulfing, oh, that is enough. Guess what? Okay. Enough. One more. Okay. So one more is let's go then. Let's go. Let's try to look at one more example of a bearish engulfing setup. Come here. Let's hunt for another smooth movement, smooth upward movement, and look at an engulfing scenario. Here we are. This is very typical. And it looks like an evening star, but it isn't an evening star, it's a movement. So okay, let's look at this. This is also a bearish engulfing scenario. Okay, right? This is a bearish engulfing scenario, right? So we had that movement. Literally for me, this is how the journey was. Then there was that retracement, then break of structure to the upside, and we registered an engulfing. So what do we do? Is that movement? Let me see. Let me see that movement here. I think that is a movement. Yeah, I think it's a good movement. That is it. So let's come back. So that is how the movement is. Now we look at a bearish engulfing. So meaning in this case, what are we going to do? So it's going to be simple. We're going to wait for that bearish engulfing candlestick to close. We're going to make entry at the next candle open. We measure from the next candle still open to the nearest resistance, which in this case would be here. Okay, that will be the nearest resistance. Okay, in that movement that I just tracked from here to there, then to this, then to that. That will be our nearest resistance, isn't it? So we have that to that level. Okay, then we measure our TP from here to this part. Then that we capture will be our resistance. So we measure that from that point to here. That will be 1.5. Okay. This will be revisited later, but measure 1.5. And for purposes of probably basing on the mean average, you would measure from here to midway. That's around 0.7, and that is the margin call drop for that. But since it is small, we could even go for 1.5. There's no problem, right? And that will be your setup. That will be your setup. That will be your setup, which I'm very sure it will deliver. It will, under all cost, deliver. As simple as that, that is for a bearish reversal pattern. Is that okay? Is that okay? Is that okay? Okay. I'm saying it is enough. Is it enough? Let's look for the next. Let's look for a bullish one. Bullish candlestick pattern. Push. Let's look for a bullish reversal pattern. Let's set at 1. This could be 1, but I want what is yeah. I saw 1 there, but we can. This is a very serious. This is a shooting star, right? This is a shooting star, isn't it? We looked at a shooting star at the time. Bullish engulfing pattern. Yeah. Here we go. Much time. I want a bullish engulfing. I think we have one here. This is one. Do we see what happened also? This is one bullish engulfing formed in the course of this movement. So it was a massive movement there. So just like from what we said, make entry on the next candlestick open, which is this here. Take profit to the nearest resistance, which in this case can be here on this area where we're seeing multiple reaction zone, or here. You can take it back to that resistance. And that will be your measurement. That will be your TP. That going to that. That would be the. Okay. That is an example of a bullish engulfing. Another example of a bullish engulfing is this. See here. This is another example of a bullish engulfing candlestick. You see it here? You see that? Yeah. Another example there. So they're common. You will find them often. It's just a matter of paying attention. Not that they may always happen, but when they happen, that is what happens. That is how you go about them. And they're mixed bullish reversal or bullish market structure formation candlestick pattern, right? That form. So you may not only pay attention to the bullish engulfing, you may have a couple of others like the morning star, which you're going to look on maybe tomorrow's class. Going to look at it. Then you may have the hammer. So any that forms, like in this case, this is a hammer. You can see this. This is a hammer. It is also a bullish signal. You see that? At open, immediately after confirming that it is a hammer, just make entry on the next candle open, take profit to the nearest resistance, which in this case, our nearest resistance will be there. And that will be good for you. No hassling. Okay. So there are a number of them. We're going to look at a number of bullish example of what I'm giving you. This is a bearish engulfing. This is a bearish engulfing here being formed there. As you can see that in the course of that movement, of that market price rise here, that one, that movement, resulting into formation of a bullish engulfing. So it's clear. Or a tweezer bottom. Let me just see. Let's look at that and probably call it, let's see this. It must appear like one, but let me see if I can see any tweezer bottom. I've come across any tweezer bottom or any tweezer top. Tweezer bottom, tweezer bottom. Can you see any tweezer bottom? Tweezer top? Can you see something here? There was that movement, and then that, and then that massive downward movement. See that scenario? See that? It seems to be a tweezer top. And say it is a bullish bearish reversal candlestick pattern, isn't it? That is formed in the course of any upward market price movement. Let me see. Can I find another? Yeah. You can also go and look out. Let's try to find your time and try to look out. If you'll find, you may not find in all the candlestick, or if it will be found, it will always appear so once in a while. But when it does, that is how that is. Let me see this. This is a bullish engulfing. This is a bullish engulfing. It is not a tweezer. It wants to appear like a tweezer bottom, but I think if you magnify it, it is not. It is not a tweezer bottom. It is rather a bullish engulfing, because looking at the low, they have different lows. They have really different lows. The red one has a more lower low than the green one, so it just qualifies to be a bullish engulfing. So yeah, you can equally go to look through at your free time. The tweezer top, tweezer bottom. Okay. Yeah. Okay. Candlestick. Let's just see if I can find in another candlestick. If I don't find in another coin, then you can also take your time and try to look through. You may come across any of those candlestick pattern we talked about. Find any, it will really be nice. The most common ones: bullish, bearish, engulfing, bullish, engulfing, hammer, shooting star. They're the most common one I'm seeing here. The most common candlestick pattern that was formed here. Oh, I've not seen one, but possibly I will cite at one and share with you tomorrow. But I've not seen, they're not, the tweezer top and tweezer bottoms are not so common here. I'm not quite seeing them. But at least you have the picture already. You have the idea of what we just shared, and I hope you try to utilize them. That you may not find it today, but you may someday find it when you want to, when you're doing your own analysis. So once you see any of those, either the tweezer bottom or the tweezer top, know what to do. Okay, know what it signifies. Okay, know what it is trying to tell you or inform you about the market, so that you make an informed decision. Okay. Okay. I think we have one here. This is a tweezer. This is a tweezer bottom. I don't know whether we see. This is a tweezer bottom. At least I got a chance of finding one. It is here. We said it is characterized by a red candlestick and then a green candlestick with equal lows, right? They have equal lows and they are strong bullish reversal patterns. So you see, it is formed in the course of a downtrend. And when they are formed, you see what happens. There was a strong bullish movement recorded. So it's really good. It's really good. That's why I told you that you would make entry where? Here. And then make measurements from point of entry to the low or to the low of the two candlesticks forming the tweezer bottom here. Okay. Then you take profit to the nearest, you measure and take profit to the nearest resistance. So meaning if you enter here, this will be your immediate reasonable resistance point here. That level would be the most prominent resistance zone for you. Okay. That will be the most prominent resistance zone. It's that simple. See, trading is patience, okay? That is what you're supposed to do. You need to be patient. Prices are bound to fluctuate, but they shouldn't give you heart attack. You shouldn't see yourself floating a little bit and then you have heart attack or you close your trades in losses simply because, unless you really can't help it, unless the floating loss is so huge to an extent that you feel it's going to be a waste of time or it will take you some time for it to close, that's when you can have some moment of a new beginning. because some of those coins probably would have entered them so early, like some of them 1 year ago, 6 months ago, like 4 months ago, and they really show no signs of recovery that soon, and you find it is tying up your capital. The best you can do is you can say, okay, let me have a fresh start. Let me try to trade those volatile coins, the coins that are at play at the moment. Because some of those coins that float for so long will remain in floating losses for so long. The next news you're going to hear, you may hear that they're going to delist them. So they're always not good coins to trade. I believe they shared with you some of the strategies to use when you're trying to identify coins to trade. You don't just trade any coin. Even if they're pumping, don't just trade any coin. There are a number of coins that personally I don't trade, and I think even in the signal that I share, that I've really not so much shared them. You may find me trading some specific range of coins only. Why? Because of a reason, you can't trade all of them. Some of them are really so volatile in that they may fall in the categories of the pump and dump. And I don't think you would want to trade the pump and dump coin. Pumps hard, dumps hard, so it's always very important the kinds of coins you're trading. Yeah. All right. So let's have a great day. Now, about the people asking about the time frame, I wouldn't recommend which time frame you can use. You have to choose what works for you. For me, most of my analysis and entry is based on the 15 minutes time frame. That is me, ever and always. That's how it has been. And if I want to look at a bigger view, I want to look at the status of the market. I forecast the status of the market in the course of the day. That's when I go for the 1 hour, and occasionally on the 4 hours, but mine is always within that range. So that is mine. So if you want to adopt it, fine. If you also want to adopt your own, you're free. But that is me, and all the signals I share are based on the 15 minutes time frame and a forecast of how the picture of the day may look like based on the 1 hour time frame. Yeah. So yeah, I do have a Telegram channel, but I don't share recordings there. And also I have a YouTube channel, but I have only recordings of some specific insights, but not of a training. I mean, not of a Zoom session of this nature. They're only about that. You'll find on the recordings, maybe once some recordings, or when I'm either on my other program, maybe of the mentorship, the one-on-one mentorship. Some of them I've tried to record and shared in the YouTube channel. But I don't record most of the training. So if you want a training here of this nature, which is conducted on a Zoom under the Royal Q Revolution, you can find it on the Royal Q Revolution YouTube channel. All right, you can find it there. Yeah, you can find it there. But if you want those specific ones on those insights on the sessions I'm handling under my own private arrangement, you'll find them on my YouTube channel. It's called the Smart Traders Academy. So you'll find them there. There are a number of videos you can also find. You can learn something from it, 1 or 2. You can pick something from there. But otherwise, most of my videos, I don't record them. Call sessions, I don't record them. Yeah. So I would request, leader, I don't know if the leader Doris is around, you could drop the YouTube channel, the Royal Q Revolution YouTube channel, for those who might have missed this to go and catch up and try to go through what we shared today. Meanwhile, I'll also share for my own personal YouTube channel, that whoever may be interested in wanting to find a few videos here and there. Yeah, you can as well go and also look out for that. But you subscribe. Some people don't like subscribing. You subscribe. You should subscribe to both of the YouTube channel. Try to subscribe, hit those notification bells, so that at least when any new video has been shared or there's any update, you can be among those who will be notified and you go and catch them up in real time. Okay, so you always have to subscribe for them. And above all, yeah, you can comment, you can like, you can give your inputs. It is always very important you give those feedbacks. At least it helps also those who are training to try to see how best to help possibly if they can. Yeah. So that's my YouTube channel. You can find it there. It's called the Smart Traders Dash Academy for those who may be interested. So otherwise, it has been a good experience having you guys on, and I'm really humbled that I'm able to take you through in our morning's technical analysis sessions for the course of the week, for yesterday and today, and for days to come. Possibility maybe only for this week, unless otherwise, then I may step in if need arise. But I'll be taking you through the course of the week. Then other leaders will step in to pick up from there. So do have a blessed day and happy trading. Remember, at the time, the market is really funny. So the best you're going to do as you're making your tradings, try to so much observe. Try to so much use, employ risk management. Okay? Trade intentionally, trade objectively, trade wisely, and trade smartly. Because if you don't, you're going to be trapped. The market is really very funny. We hope it turns out and goes so well, but take little profit. At least that I can tell you now. Take little profit until maybe the market recovers, and then we can go for those other big TPs, okay? So do have a blessed day, and see you hopefully tomorrow, inshallah. Bye-bye. You can leave at will.